Okay, so just a quick introduction of myself. I'm Lee Sing. I provide FX advisory to institutional clients. I'm also part of the team that's recognized by the Technical Analyst Awards as finalist for the best FX research. You can also find me on LinkedIn. So along the way, if you're watching a recording of this, right, please feel free to reach out to me on LinkedIn. So for those of you guys who want access to the recordings, right, you can actually find the recordings on Vantage YouTube page. So just Google Vantage Markets YouTube. You should be able to find the recordings there, right? Alternatively, we can just go to the website. So I'll show you guys that in a moment, right? So just going to the website to access the recordings. Okay, I have a question, right? Do you have office in Manila, Philippines? What's the address and who will be the contact person? So for this, right, you can actually reach out to support@vantagemarkets.com, right? So let me just show the email here. So John, with regards to that, right, just please feel free to reach out to support@vantagemarkets.com. Okay, so just a quick disclaimer. The information presented here is not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today. We will first take a look at supply and demand zones. And following that, we will be taking a look at how we can combine supply and demand zones and place them all together. Right, so this will be the session that we will be covering for today. So let's cover a bit more on understanding market structure first, right? So before we cover supply demand areas, the idea is to understand where it's the general direction of the trend, where are prices heading towards, right? So for this, we can categorize market into three types. The first one would be markets in an uptrend. So we can see in an uptrend, prices are forming successive higher lows and higher highs. So this is an example of how it looks like when prices are in close. Of course, right, this is in theory. If we load prices on a chart, you can see that this would be it will be more reflective of actual conditions, right? So in this case, we can see that you can just mark out the significant high and low points. You can see prices forming higher lows, higher highs, just mark out the significant swing points. So this is important because when prices are in an uptrend, we can see that it forms successive higher lows and higher highs. But more importantly, the idea behind this is that if markets are in an uptrend, we are not expecting price to break below the next low, right? So if price, you can see in this example, market broke below the previous high, which is this high over here. And following that, when it did a pullback, right? If the uptrend is to continue, we are not expecting price to break below this low. What this can also suggest is that if we are taking any positions, right, we can consider taking our entries within this leg itself. And with the assumption that when price breaks below this low, this is when we want to get out of the position. So of course, the other concept would be trying to identify our risk to reward ratio, right? So with this in mind, you can see that if prices, right, so this is a whole move up. So if price pulls back into a demand area, the lower it goes, right, as long as price is in an uptrend, your risk to reward ratio would be somewhere along here, right? And this is the place where we want to get out of the position, right? If we are wrong on the direction of the setup. And then in an uptrend, you can see that the highs themselves are weak, or this highs, this resistance are constant targets. So in this case, right, even though the concept is simple, we see prices trending higher, forming higher lows and higher highs. When we combine this across different time frames, we can actually derive a very insightful analysis, right? So we will go on to that example in a moment. So the other type of setup that we have would be markets in a downtrend. So in this example, you can again see right here, when markets are in a downtrend, it forms clear lower lows and lower highs. You can see lower lows, lower highs being formed. And this is again another example that we have on the left, right? And if we load a chart, this is how it looks like in a downtrend, successive lower lows and lower highs being formed. And I've also marked out the highs and lows denoted by the blue and gray dots. What is important to note with this is that we can see in a downtrend, the highs themselves are not violated, whereas the lows are constantly broken. So what does this show, right? It shows us that when market is in a downtrend and it comes into a resistance area, these are potential areas that we can take shots from and targeting the lows that we see here. Because in a downtrend, we can see the support levels don't hold. Okay, so that's the other thing to take note of, right? And then of course we have market ranging sideways. So when market ranges sideways, basically it's moving in a direction where we don't have a clear view of where it's headed. you can see in this example, prices are respecting both the resistance as well as support levels. You can see these areas here. And once again, if I were to load a chart on the right, this is an example of how it looks like. Price respecting the resistance area, seeing that rejection, and then once again for the support zones here. So this is market ranging sideways. And in this case, we can see that when markets move sideways, they're respecting both the support and resistance zones. In this case, right, we are waiting for a clear break above or below the support resistance levels before taking the position. So this example, it's important because when we move forward with this webinar, right, what we will notice is that these ranges on the lower time frame, they are essentially dojis on your higher time frame, right? So if you look at these ranges, right, so maybe just a quick recap or quick view on what a doji is. So doji itself is a candlestick pattern. What this represents, it's uncertainty in the market. The reason why it represents uncertainty in the market is because if you take a look at the candle formation, right? So we have the open or the high prices, the low prices, the open and the close price. So if you take a look at this example, the open and close prices are relatively narrow, right? So they're near one another, which means that there's a lack of direction. They cannot decide whether buyers are buying or sellers are having enough pressure to push prices lower. So in this case, right, when prices are ranging sideways, what we are seeing here, the range on the lower time frame translates to a doji on the higher time frame. And how this can help is that when we are on the higher time frames, right, if you want to look at higher time frames, market structure and identifying support demand areas, right, looking just at this zone itself would be useful, right, because we can then zoom down to our lower time frames to try and find entries. Okay, so let's take a look at demand and supply zones for a start, right? So this is how it's like. You can see that we have a prior downtrend that was being formed, prices forming lower lows and lower highs, right? So it's a prior downtrend that was established. And what we can see here, it's again, successive lower lows and lower highs. The highs are marked out in gray. The lows are marked out in blue, right? As you can see here. So you can see a clear successive downtrend as what we have covered earlier. So in this case, right, when prices are in a downtrend, we are looking at pullback areas into possible resistance or supply zones to take short positions, right, targeting the low. Okay, so that's the theory behind this, right? So you can see that when price starts forming lower lows and lower highs, when it starts consolidating at this area, you can see price coming in to form this zone. In this case, right, we need a clear break in structure, or in this case, we need demand to fail before it tells us that we're in a downtrend. So let's take a look at this chart example. What we see here is that price starts pushing lower, and more importantly, there is a break in structure. This is accompanied with a break of the previous low. See how this low fails, right? So when price starts consolidating around this area before it finally breaks below it, then it's the last candle, right? So you can see the last candle that held within the zone before it fails. So we can then say that when demand fails, right? So in this case, this is demand. We are seeing consolidation around the area before it fails. So when demand fails, it creates supply. You can see how there's this exchange of hands between buyers and sellers. So this is demand, right? Price coming into this zone, consolidating before it fails. And once it fails, it creates our supply region. And this supply zone, right, in a downtrend, you can see supply zones are being respected. What happens? Price fails the demand, and this candle was the last candle that held within the demand before it fails. So this candle becomes a supply, right? So you can see when price pushes back into the supply zone, we can see this area, supply zones being respected. And then again, when this happens, right, pushes much lower, and we have a demand zone here again. So when demand, again, understand that in a downtrend, we are seeing much weaker lows, right? So these lows are constant target. Prices are targeting these lows. So in a downtrend, we're looking at supply regions that we can potentially sell from and targeting the lows. Because again, understand in the downtrend, we can see that the lows themselves are constant target because they are likely the ones that would not hold. Okay, so this is just based on theory, of course, right? We also have to look at the lower time frames to understand that change in hands between buyers and sellers. So we have demand failing, and then once again, you can see when demand fails, which is the last candle that held within, right? You can see this area here. So in fact, this is the candle that held within here. So you can see that when price comes into this zone, we saw reaction of this region. So you can see that when price comes into this area, we saw rejection of this area before it spikes slightly higher, swept this high back into this area here before it continues to the downside. So this is one thing to note, right? The other thing I would like to highlight from this example that is clear is looking at the shift in trend, right? Just based on market structure alone. What we have here, so notice the first portion of the chart. What we have here, it's prices in a downtrend, right? So we see price forming your lower lows, lower highs, pushing much lower. And then what we have following that, it's that this is the last high that was being formed. So recall, in a downtrend, if prices were to continue in a downtrend, we should see a pullback, which should not be violating the last high, because this high was the high that caused a break in structure. Hence, we should not be seeing price break above this if the downtrend was to hold. Right? So you can see this is the last high that was being formed, the one highlighted in red. And because this is the last high that was being formed and it caused the break in structure because it broke the last low. In this case, if the downtrend is to continue, we should not be expecting price to break above the high. So the trend shift comes in here. So notice the trend shift comes in when price starts breaking above the last structure, which is this high. And when that happens, you can see that the pullback into the demand area, right? So in this case, that change in hands between supply and demand, as we have seen earlier, right? You can see that the pullback into the demand zone, this is when this itself, this zone would be a valid zone. Why? Because of the break in structure here. If there is no break in structure on this high, then this zone itself, demand zone in a downtrend, would be less likely to hold, right? So you can recall in this earlier moves, we can see that demand fails in a downtrend because the lows themselves are weak and they are constant targets. Whereas if you take a look at that change between buyers and sellers, right? So once we have the supply zone being identified, so demand fails, it creates a supply. You can see this supply zone being followed through. So essentially price coming in to tap this supply zone before it continues to the downside. And then the last exchange in hands between buyers and sellers, that's what we see here. You can see that this was the last candle that caused that break in structure. So it broke below structure. And once that happens, you can see that price came in, acknowledged the zone before it continues to the upside, right? And then this zone is the one that caused the failure of the supply. Hence, it's the demand area. So in this case, right, we might not be keen to take the first setup despite this, right? So the first check is always looking at a break in structure. If price breaks above structure, above the last high, then it increases the validity of the demand zone. So in this case, when price breaks above the last high, you can see it pulls back to the demand area, consolidate, and continue higher. And what happens after is that we see clear higher lows and higher highs being formed, right? But there are two things to note here. One is that when we're in a downtrend, you see supply zones are the ones that hold. When there is that trend shift, which is a break above the last high and a change in structure, we see that opposite move, right? Where demand areas start holding. So demand zones start holding. And how we identify demand zones, it can be based on two terms, right? So one, it's looking at the extreme of the move, right? So if we have a strong move up, then what happens is that this area over here, so the extreme of the move, can serve as a potential demand zone. And of course, the other one, it's looking at this exchange in hands between supply and demand, right? So if supply zone fails, it creates demand. As you can see here, when demand fails, it creates supply. And again, when supply zone fails, it creates demand. When this fails, it creates demand, and then so on and so forth, right? So you can see that change in hands. So two things, it's looking at the trend and looking at the market structure shift. Okay, so let's take a look at our next slide. So in this case, right, we can see that the previous example we saw, it's in an uptrend, right? Right now we are seeing a downtrend. So again, prices form a bullish trend to the upside, right? There's a parallel bullish trend form. How do we know that it's a bullish move or bullish market structure? It's looking again at the market structure here. You can see clear highs and lows that are being formed. And then what happens after is that market consolidate, forms an equal high. So for some of you guys who are looking at chart patterns, this can also be seen as a double top, right? So double top confirmation comes in when there is a break of a neckline. So this is the neckline, right? So if I draw this position, you can see that there are two conditions for a double top. One, it's we need a parallel uptrend, right? So prices needs to be forming higher lows and higher highs, and a consolidation of this, and it forms the neckline, which is a support zone or the demand area. And only on the break of the demand zone and a retest, right? And this is when you can see that once the neckline breaks, then this is the confirmation of a double top. It's also a reversal sign, right? But what we want to highlight here, it's looking at just the interaction between supply and demand, right? So you can see clear higher lows and higher highs being formed. Again, when we reach this point, right, the assumption is that in an uptrend, you can see that the highs are constantly violated, the lows are not being broken. So in this example, right, if the uptrend is to continue, we should be seeing the lows holding here, right? But instead, what we're seeing here is that price broke above the high, and then subsequently it broke above the demand, right? So demand starts failing in this zone. So at this point in time, when demand fails, again, there's that change in hands between demand and supply. When demand fails, it creates supply, right? So you can see that change in hands here. And once that happens, you can see that the supply zone would hold, right? And we have the supply region. And more importantly, it comes after the demand failure and what we also call the break-in structure. So break-in structure comes in when market starts forming clear structure and following the break of the last low, then this is a sign of a potential shift in trend, right? So we're seeing that shift here. When demand fails, it creates supply, and this supply zone, it's then respected, right? So subsequently, we can see that price tested the supply zone, continued to the downside, and before it continues much lower. But this move down, right, would not have been this move down or the respect of the supply zone, right, cannot come without this. So it only comes after price breaks below structure. Okay, so I hope it's clear so far. If you have any questions, right, please feel free to put it under the questions tab. Okay, so now we want to take a look at how we can combine this together, right? Looking at support, resistance, or demand, supply demand zones across different time frames. So just identifying one time frame, it's one, right? But the idea is that if we were to see price forming this region here, looking at just one time frame, you can see that this area itself, it's a support turn resistance zone. How so? You can see price holding it as a support area before failing and retesting it as a resistance. And this image that we have, right, it actually corresponds to price movement here. So we see price forming new lows, right, clear higher lows and higher highs. Price forming new lows. And then in this case, what happens after? It's that it breaks below, and currently it's retesting it again as a resistance. So this is basically what we're seeing here. If we're to pan out this move, we see that break below and then a retest of it as a resistance, and also looking at that exchange in hands between demand and supply. Okay, so I have a question. What's the ideal time frame for a day trader? So one would be looking at the daily time frame first, right? So for this, I'll hop onto the charts just to run through the thought process behind it. So I would say for one, right, looking at the daily time frame to identify the general direction, and going down to your 4 hours and 1 hour to identify the change in market structure. So we will take a look at a few examples on the chart in a moment. Okay, so if there are any other questions, right, please feel free to type them under the questions chat. So let me just bring up the chart. And let's see an example here, right? So I'll just share this. Okay, so this is an example on euro dollar, as you can see here, right? In this example, again, if you're on the daily time frame, so just to walk through the thought process, I will look at the monthly, the weekly, and the daily. These are higher time frames. Essentially, what this does is that it helps us to determine the general direction of the market, right? So if prices are sitting or testing a potential region, right, this is an area that we want to consider, especially on the higher time frames. So the higher time frame you go, right, these levels are likely to hold more weight as compared to your lower time frames. And the reason behind this is because what we're seeing on the 5 minutes, right? Each candle that we're seeing on the 5 minutes, for example, you can see that this open, high, low, and close price itself, right? This movement would be a lot more choppy because these levels don't hold as much weight on the lower time frames, right? As compared to, let's say, the weekly, where you are taking 4 data points of the whole movement across the week, right? So let's say for the week, we are looking at, let's say if you're on the 4 hours time frame, right? For 1 week, let's assume that it's 3rd July, right? So somewhere here. So essentially, to plot all this data, right, what it does for the weekly candle is that it takes all this data, identify the highest, the OHLC values, so this 4 values, and this would generate 1 weekly candle. So because of this, you can see how when we are on the higher time frames, right, this would be less choppy because it covers a wider range of the market movement for one candlestick pattern. Okay, not seeing the time frame. Oh, let me just change this. Just give me one moment. Sorry for that. Okay, can you see the time frame now? All right, thanks for that, John. Okay, I have another question, right? Do you take into account the body of the candlestick, including the wick? Yes, I do take into account the wick as well, right? Reason for that is because the wick itself would represent the high and low prices. So in this case, right, if you're on different time frames, if you don't take into account the wick on different time frames, right, it shows differently. So let's take an example, right? If I have a high that's here, if you take into account the body of the candle, right? So let's say this movement. So you can see that if I take into account just the body of the candle, the high would be at 1.09, right? But if I switch the time frame down to the weekly, you can see that these levels are different. Whereas if I'm on the lower time frame and if I take the wick of the candle, right, even on the higher time frame, this wick itself is reflective across different time frames. So that's the reason why I will take into account the wick instead of just the body. Okay, so I hope that answers your question. So when you're looking at the candlestick patterns, right, try to take into account the whole candlestick, just the highest point and the lowest point, because across different time frames, right, if you don't do that, right, and you take into account just the closing price, then this level or this value would change based on the different time frames. But if you take into account the high and low prices, right, on the 4 hours time frame, the weekly, right, it would reflect the same level. As long as this is the highest point for that week, right, on the 4 hours, it will still be the highest point. On the weekly, it's still the highest point. Okay. So I hope that answers your question, right? What do you mean by closing price? Okay, so what I mean by closing price, it's assumed in this case on the weekly, right? So in order to understand closing price, we need to understand the formation of each candlestick pattern first, right? So if you have one candlestick pattern, right, essentially it's formed by 4 data points, right? So the open, high, low, and close prices within the wick itself. So when the wick open, right, what's the starting price? When the wick close, right, what's the starting price? So that's the closing price. Okay, but when you are on the lower time frames, right? So on the weekly, if we take this candle, you can see the closing price is at 1.09. But if you're on the 4 hours time frame, right, then each candle have a different closing price. Which is why, right, as much as possible, right, to answer your question as to whether we want to take the highest price, or the, excuse me, or the close price, right, as much as possible, we try and take the highest price. Okay, please share this PowerPoint after the session, right? Yes, the session will be recorded, so you can actually find them on our YouTube page. Okay, I'll show you guys that in a moment. Right, so for the sessions, right, where you can find the recordings. Okay, so back to our charts. So in this case, right, when we're looking at market structures across different time frames, right, let's just highlight this first. So you can see that this area, right? So previously I talked about market ranges, right? I look at how prices are trading sideways, and that itself, it's nothing but dojis on the lower time frame, on the higher time frame. So if you see market trading like this, right, moving sideways, what this translates to on the higher time frame, they are potential dojis that we're seeing, which represents uncertainty in the market, a lack of clear direction, essentially, right? So one thing to note is that you can see this, it's the most recent move. And this is the doji on the weekly time frame. So if I were to highlight this doji, right, this doji itself, this doji represents a range on our lower time frame. It means that at some point in time, at a specific time frame, what we saw was that markets were trading, respecting the support and resistance level before a clear break below this range. So for those of you guys who trade breakouts or ranges, right, when price breaks below this level, this range itself then becomes a supply zone or resistance area that we can see a potential retest. So on this note, right, if I were to move down to the lower time frames, so just highlighting the same doji we have on the weekly, if I were to move down to, let's say, the daily or even the 4 hours time frame, right, you can see that this range that we're seeing here, this doji that we're seeing on the weekly, They are nothing but ranges on the lower time frames. Right? So if you are able to identify the dojis on the higher time frame, it's the same as identifying a specific range that price traded within for a period of time before it fails. And why this is important, it's because when price comes back into this level, right, we can see that these are areas that price could potentially reverse off, right? So in this case, right, the reason why we want to use the higher time frames is because it's less choppy as compared to your lower time frames, right? So in this case, this example that we see here, right, on the higher time frames first, we identify that prices on the weekly zone, you can see that it's respecting this resistance area, right? Just looking at zones that prices interacted with across this area multiple times, you can see price coming in to test it as a resistance twice. And right now, this area, if I were to put it in close, you can see I can also draw a horizontal line across, and this is an area that price respected previously. So if we see prices testing the weekly zone, right, and we move down to the lower time frames, let's say on your daily or 4 hours, what we're looking out for here is that when price comes into this zone, right, we can see here, when price comes into this area, we can see clear market structure being formed, right? So again, if I were to mark out the highs and lows, you can see higher lows and higher highs. If I were to put these levels in close, right, just mark out the significant points. So you can see a high being formed, price form a new low. And prior to that move, we have clear bullish market structure form as well. So recall, we mentioned that when prices are in an uptrend, when price pulls back, right, as long as it holds above the last low, we could see price continue to the upside potentially, right? But the trend shift comes in when there is a break in market structure. So the question to ask ourselves is, how do we know whether price would respect this area, right? It could respect this area as a resistance, or it could just continue higher. It could continue to form higher lows and higher highs, pushing deeper into this zone. So in this example, we can see that price form equal highs and lows here, and subsequent clearer highs and clearer lows. But what happened after, it's that following this, right, this is the last low that we have, or the last structure that we have here before price broke below structure. You can see this is the last low that was being formed. Price broke above the last high here, right? So price broke above the last high. So the assumption is that if price continues in an uptrend, it should continue to form your higher lows and higher highs. But instead, what happens is that instead of breaking above the last high, it broke structure. And this is then a sign of a potential shift in trend. Okay, so with that, right, the idea behind this is that while we can identify the higher time frame zones, so if we look at support or resistance areas on the higher time frame, we need the lower time frames. In this case, I'm just looking at the weekly and daily time frames, right? We need the lower time frames to identify this change in trend or change in structure before taking any positions, right? The reason for that is because if we are on the weekly, price could always continue to the upside. It could continue breaking this zone. But if there's any respect of this area as a resistance, we will see price consolidate and start that trend shift just based on a change of trend and a change of market structure on the lower time frame, right? So recall we talk about the 3 market structure, market in an uptrend, in a downtrend, and sideways. So if prices are pushing strongly into this resistance area, then markets are in an uptrend. How do we know whether this resistance is going to be respected, right? The reason why we would know that this is, or there's a chance that this will be respected, is because there is that trend shift in trend, which would then signal the reversal. If not, right, prices would continue likely to the upside. Okay, I have another question. Is RSI indicator useful with price action? Okay, this is an extremely interesting question, right? I would say that it depends on what kind of price action we're looking at. Okay, so in general, RSI indicator, maybe just a brief outlook, brief view on RSI indicator, it's an oscillator by itself. So how this works, right? Let me just load the RSI indicator. So how this works is that it measures both overbought and oversold ranges, right? So the idea of how it's generally used is that when price enters the overbought region, which is above 80, and it reverses below, then this itself, it's a sign of reversal in prices. If price is in the oversold region and it exits the oversold region, then we can see price pushing higher. So that's the general interpretation of an RSI indicator. But understand that this itself would work better in ranging markets, but not so much in trending markets. Why? Because if we take a look at the same example here, right? So we see that prices are trending strongly. Let me just move down to the 4 hours. Probably it's clearer in this example, right? So you can see in this example, Right, so in this example here, we can see that prices are in a strong downtrend, right? So we can see clear lower lows and lower highs being formed. So this move, if I were to mark out the highs and lows, you can see clear lower lows and lower highs being formed. So in this case, right, if we're just trading solely based on RSI indicator, when RSI exits the oversold region, right? So in this case, you can see this is one exit, this is the other exit. This itself, what this means, right, it's a bullish indication. So we should see price pushing higher. But notice what happens in a downtrend, right? Any exit of the oversold region itself is just a slight pullback before price continues to the downside. And then once again, we're seeing the same thing here. When price exits the oversold region here, we're just seeing just a slight pullback before price continue to the downside. So my answer to your question, right, as to whether RSI is a useful indicator, I say that it depends on market structure. If market is in a downtrend, what we want to focus on would be RSI in the oversold region. So you can see that when market starts ranging and we see a clear sign of break in market structure, right? In a downtrend, we want to look for opportunities to sell, right? So in this case, when RSI exits the oversold region, these are areas for potential entries. But when market is in an uptrend, you can see that when market starts changing direction, and the first sign of a break in structure comes in here when price breaks above the high. So this is the last high that was being formed. The last high that was being formed, instead of pushing to form lower lows and lower highs, price broke above market structure, pulled back, right? So once there is a trend shift over here based on market structure, you can see that when RSI enters the overbought region, which is this high, you can see when it enters the overbought region here, right? Instead of looking at any exits, you can see this overbought region, right? What this corresponds to is just a slight pullback before it continues to the upside. So in a bullish market structure, we're looking for price coming into the oversold region to buy, right? Whereas in a bearish market structure, we are focusing on the oversold regions. The overbought regions here. Okay, so is RSI a useful indicator? Yes. If you can combine it with price action and market structure, then this would give you an area to focus on, right? So if markets are in a downtrend, we want to look at areas that we can potentially sell, right? So if markets exit the overbought region, then in this case, right, this will be in line with our market general direction of the trend. But to trade RSI in isolation, right, it's not ideal, simply because when if you look at RSI, right, if prices are in a strong uptrend, right, even though markets exit the overbought region, right, prices just continue to trend higher. So in this example, right, if you are selling just based on every exit of an RSI in an uptrend, we will be caught in this slight pullback before prices continues much higher. So the general direction of it, right, would be looking at the overall, right, looking at market structure to identify the general direction. And once we have identified that, you can narrow it down to focusing on whether RSI is exiting the overbought region or the oversold region here. Okay, so in an uptrend, right, we want to focus on RSI exiting the overbought region. And in the downtrend, in the downtrend, we want to focus on RSI exiting the overbought region. In the uptrend, we focus on RSI exiting the oversold region. Okay, so again, right, you can see here, when there is a change in market structure, this move over here, right, when RSI enters and exits the overbought region, right, this itself corresponds to a slight pullback before it continues to the upside. And then what we saw after is that, again, a change in trend, right? So markets forming lower lows and lower highs. So in a bearish market trend, bearish structure, you can see that when price starts forming lower lows and lower highs, one thing is that price or RSI hardly pulls back into this overbought region. Okay, so that's something to note, right? So as much as possible, we want to narrow down the focus on RSI, right? So if your RSI, it's exiting this region, right, look at market structure. If it's in a bearish market structure, then in this case, right, we focus on the overbought region. Because what this means is that any pullback into a resistance area, right, if RSI exits the overbought region, right, it could be in line with the higher time frames direction. Okay, so I hope that answers your question. Right, so for those of you guys who are looking at the recordings, right, if you have recordings of this, right, please feel free to type it. You can actually search for the recordings here. So just go to vantagemarkets.com. And under education and tools, under educational webinars, right? So just click on this. You can see the different sessions. You can sign up for them. And under recordings, you can see the other recordings, right, that were done. Specific to RSI indicator, we did a series on it. focusing on specific examples, right? So you can actually view these recordings on Vantage YouTube page. Okay, so, yep, okay. So let me just switch my screen. Okay, so in summary, right, what we have covered so far, we look at understanding market structure. So there are three different types of market structure, looking at bullish, bearish, and ranging market structure, and understand that when prices are in an uptrend, it will form higher lows and higher highs. And in this case, right, what we want to focus on, be it on if we are looking at price action, would be looking for demand areas for potential entries. And if you're focusing on other indicators like RSI or even stochastics, oscillators, right? In an uptrend, we want to focus on oscillators exiting the overbought region, the oversold region, which is crossing below 20 and then out of the range. Whereas in a downtrend, we want to look at oscillators exiting the overbought region. Okay, so in this case, of course, this is just the general idea, right? But if you want more in-depth series on this, right, do refer to our RSI and stochastic series. We also look at identifying supply and demand areas, understand that when supply zone fails, it creates demand and vice versa, with the examples that we saw on the charts, right? And looking at specific areas. So these specific zones, like in the example we saw on euro dollar, right? If we see prices coming into a weekly supply region, and this weekly supply region here, right? In order to understand whether price would respect this zone as a resistance or it will continue pushing higher, we need to look at the lower time frames. So in the example we saw on euro dollar, right, we look at how price came into the weekly resistance areas, and this is also accompanied with a change in market structure on the daily time frame. So recall that price starts breaking the low, and this in turn would then more or less validify that this resistance area, right, is indeed holding. Right, then of course on risk and trade management, I won't cover too much on this today, right? We'll cover more on the future sessions, but understand that each position itself, right, try not to risk more than an X amount of percentage for one trade, right? The idea is that we want to ensure that we are practicing proper risk and trade management, right? So okay, let's take a look at, okay, I have a question, right? Can we use price action when trading gold? Yes, right, definitely you can, right? So looking at gold, right? So let me just bring up the chart. Okay, so in this case, right, this is the chart here. And so if we take a look at gold, it's the same idea. And so on gold, let's take a look at price action for start, right? So again, I'll remove all this here. So on the monthly time frame, first, just on gold, we're seeing that price it's coming into a potential resistance area here. On gold, right, tested multiple times. If you move down to the weekly time frame, you can see right now where we are on gold. It's that prices are coming into a potential support zone, but it's consolidating. Partly also gold, from a fundamental perspective, it's a dollar-denominated asset, right? So following yesterday's FOMC meeting minutes, we see that markets are expecting Fed itself, they're driving for at least 2 more interest rate hikes. So in this case, if dollar strengthen, then gold itself would weaken. But from a technical perspective, you can see that if you're on the weekly or daily time frame, we're right now seeing a consolidation around these areas, right? And also if you look at just supply demand areas itself, right, looking at that change in hands between supply and demand, you can see this area, right? This is the previous resistance, price failing that resistance, and right now it's currently holding below this zone. So right now this is the support area because this resistance area failed, right? This resistance, and even if I have to put it in close, you can see that this was the previous high. The price broke, and currently it is testing this region here. So that's the picture on the weekly, right? If you're on the daily time frame, right, you can see that this, just on the daily alone, we have price currently consolidating. So with respect to the most recent moves, we see that prices are currently consolidating. But notice that this move here, so if I have to go back to the weekly and just mark out the weekly demand, so we have the weekly demand here, right? If you go to the daily, right, notice that on the daily or even down to the 4 hours time frame, it's still showing you bearish structure, right? So look at the most recent move pushing into this demand zone, right? If I have to put these levels in close, you can see just marking out the significant highs and lows. What you see here, right, on the daily or even on the 4 hours, just clear this. Right, so you can see here, right, prices are still forming lower lows and lower highs. So until this high, which is the last high that was being formed here, when price forms or breaks above, on the daily, it's probably clearer, right? So I'll draw it on the daily. So until price breaks above the last high that we have formed over here, right? In this example, you can see that right now we will probably be seeing some consolidation on gold. But at the moment, right, there's no clear direction, because if you're looking just based on market structure, prices are still forming your lower lows and lower highs. You mark out the highs and lows, you can see the subsequent move, right? As to whether price would respect this demand area or this resistance area, that resistance turn support area previously, right? We need price to start forming clear bullish market structure for continuation to the upside. Because if not, right, where we are on the daily, it's still bearish. We're still seeing price form your bearish structure, some kind of consolidation area here, but in terms of market structure, right, there is no clear sign of bullish move. Okay, so yes, you can actually use this on gold as well, right? I hope that answers your question, Afia. Okay, so with that, okay, is MACD an effective indicator for price action? So MACD works better in trending markets. So depending on the range that you're working with, right? So we do have a MACD series covered as well. I believe it's also posted on YouTube, right? So we covered MACD series last month, right? So for this month, it's more on price action, but MACD itself, again, right? It depends on the price movement. So if I were to bring up MACD, you can see that this itself is a technical indicators, right? So a technical indicator. So for those of you guys who are not familiar with it, how it works is that when price is in the negative territory, right? Usually this is a bearish signal. If we see a MACD crossover, so there are two lines, right? We are seeing a orange line and a blue line. The orange line is a signal line. The blue line is the MACD line. So when the MACD line crosses above the signal line, it's a bullish signal, right? And vice versa. So in this example, right, if MACD crosses above 0, and if it holds above the signal line, and in this case, right, if it ties in with a bullish market structure, if gold starts forming, it starts consolidating, and we see that clear change or clear break above the last high, then when MACD crosses above 0, right, this would be an indication, or this would give us further signs of a potential move to the upside. So using the same example, let's see if we can actually see this, right? So in this example, you can see that when price starts forming or coming into a resistance area here on the daily time frame, you can see on the weekly, right? So we have price pushing in to form a resistance area here. So when price starts forming resistance region here on the daily time frame, or even on the 4 hours time frame, right, you can see that pushing into this zone, pushing into the resistance area that we have over here, right, prices are still in a bullish structure. Clear higher lows, higher highs being formed. And this is the last low that was being formed, which did not break above the high. And what happened subsequently is that price then broke structure. You can see price breaking below the low here, right? So once there is this break in structure on MACD, then in this case, right, the MACD that we want to focus on would be MACD going into the negative territory, and also MACD crossing below the signal line. And the reason why, it's because it ties in with our bearish market structure. Once we see a clear break in market structure, you can see that when MACD crosses into the bullish signal here, right, it just represents a slight pullback before continuation to the downside. Right, so if I were to move back slightly, you can see that when MACD crosses above 0, right, in a bearish trend here, right, it represents a slight pullback and movement to the downside, and then once again here. So again, right, MACD and any indicators as well, right, we need to ensure that this is in line with our market structure. If you're looking at bullish market structure, then it makes sense to focus on MACD crossing above 0 or MACD crossing above the signal line. If we're in a bearish market structure, we want to focus on MACD crossing below the signal line and below 0. Okay, so I hope that answers your question. Okay, so if there are no other questions, right, that's what we have for today. Let me just share my screen. Okay, so if there are no other questions, that's what we have for today, right? For those of you guys who want to sign up for the next few sessions, right, you can just go to vantagemarkets.com/webinars, right? And if you have any questions with regards to account opening or any support, right, please do email us at support@vantagemarkets.com. Okay, you're very welcome, Kati, right? I hope you enjoyed the session, right? So thanks for staying with us till the end, right? Have a great weekend. have a great week ahead, great trading week ahead, and we will catch you guys again tomorrow.